Stop looking at every high or low as a liquidity grab. In the market, there is always a lot of highs and lows that are being created, and the market will always use some specific highs and lows to either reverse, take liquidity, or make some moves that you can be able to take advantage of. But the problem lies in identifying which high or low is the market going to use to be able to take that specific trade. And if you look at it, if you want to be trading randomly and be considering every high or low, that is where your failure is going to start. In this video, I'm going to take you through the major highs and lows that the market will always try to use as external liquidity grabs. If you have already gone through my previous videos, this video will become very easy for you to understand. By the end of this video, you should be able to understand the highs and lows that are seen as external liquidity grabs. If you look at this place, market started from here and we create this high, and from the previous videos you already understand this becomes a major high, and then this only becomes a major low after this low is being broken, this high is being broken. So it creates this liquidity, we come back for it, and then this becomes a major high, and this also becomes a major low only after this high is now broken. We use this to mark the major highs and lows, and that is where the interesting thing is. As at this point, you can see that from this place, from this high here, the market took liquidity here from this high, and after that it came all the way down here. The problem is that on top of this major high, like the way I explained it, normally when you are selling from this, you put your stops here. So the market will find a way to come back to that high, take the high out, and then it will go to the other direction. And when it comes here, this is also a major low. It takes that low out and then grabs liquidity from here. From this point, then it reverses the opposite direction. The same thing is going to be happening here. If you are able to mark the major highs and then the major lows right, you'll be able to understand which high or which low is it that I can focus on, so that if the market takes this high or low out, then I can look for confirmations to take the trade from that place. I think this should be able to explain it. If this explanation isn't the best for you, go to the previous videos. I've already explained why this is a major high and why this is a major low, and then the liquidity. And to clear things out, the liquidity that we have already used to understand the market structure is the internal liquidity. So right now we are going to get into the external liquidity. These major highs and lows you are seeing, they are the external liquidity. This is external liquidity, this is external liquidity, that is external liquidity, this is external liquidity, this is external liquidity. You are not going to just be focusing on every high or low in the market. That does not mean that the market, to anytime it takes a major high or low, then is going to reverse. No, it's always at the reversals and sometimes in the continuations. And if you understand the direction of the market too, then you always have to go with the flow of the market. Then you understand that if this major low or high is taken out, then we will get into this. These are the liquidity types, and I'm getting into them one by one. This is the external liquidity graphs. I will explain this, and then we can get to the relative equal lows and then trendline liquidities. I think this is enough for the explanation. Let's get into the charts and then be able to use this to explain more better. If you look at this chart here, this is GU. I've already always marked the highest and the major low so that it becomes easy for us to be able to identify. If we look here, this was a major low, and then it created this major high here. This major high becomes valid after it has taken this low out, and then they created this low. When this high got broken, then this becomes a valid major low. Now you can see that instead of the market to use this high and trade all the way up, they rather came back into that lows. First, this, if you understand what I've been teaching before, you will see that this is the low that caused the break. This becomes our internal liquidity. This becomes the internal liquidity here. This one, because that's the one that caused the break. But market came, traded to that major low, feed more liquidity into it. This now becomes relative equal lows. We will target that in the next video and move to the upside. That was a trade. Now, after that, the market came all the way back to attack this low, and from there, it moved to the upside. Immediately, this low was being taken out. That is external liquidity because we have already identified this low as our major low. So we know that if the market takes that low out, then we can be preparing to find some confirmation entries here, and then we take the trade to the upside. If you don't understand how to mark the major highs and lows, go to the previous videos and you'll be able to understand it much better, and then come to this one. Here it was taken out and price moved all the way up. Now if you look at this high here, this high becomes valid after it has taken this low and this lows all out. So that becomes a valid major high. Now, when the market traded back into that high, they took the high out and the market traded all the way down. There was a gap here. This could be some kind of market open. But if you go to the line chart, definitely you will see that market has just dropped from there after it has taken this major high. And remember, we are using the wicks to be able to understand it. This high, after being taken out, confirmations here, you check it, you take the trade to the downside. And what happened again, immediately this high, which we identify here, was broken. We have to identify the lowest low as our major low, a valid major low. And this would have been the valid major low, this low here. We expect the market to trade back and then push to the upside. But they traded back to it. You can see this low here. Before they traded back to it, they already came to this low here. You see, this is the first time they come to respect the low and trade back. But understand that during that time, they did not take out this low yet, and they already fed liquidity into that low, this major low here. Hence, it becomes liquidity now for the market to target if market is coming back there again. They came back into that low, take the low out here, confirmations here, and then you take the trade all the way to the upside. So you can see that it was not just random highs and lows we were marking. There are many highs and lows here. All these highs were there, but this was not our focus. Our focus was exactly on these ones. And if you understand that these are the major highs and lows, and if they are taken out, you wait for your confirmation and take the trade to the downside. This is very important, that you wait for the confirmation, because sometimes it can just sweep and then still move to that direction depending on the direction, the directional bias. You always need to support your bias with the liquidity. If we go here, we can see that structure was not created here. All this was just noise. And then we created this high here after it has taken this low, and then this major low was formed. I wouldn't be spending more time to explain the major highs and lows again, because we are focusing on external liquidity now. So if you want to understand more of that, watch the previous videos. So you can see this becomes a major high after it has taken this, and now this becomes a major low after it has broken this major high we identified. Now we are waiting. Always look at how price will come back. It will come back into the low, but it wouldn't take it through push, which we expect because this is a buy structure, and then it pushed to the upside. But then it feeds liquidity into this low. It feeds liquidity into this low, and price come back. Immediately they take out that low. We are taking confirmation from this place, and we take the trade to the upside. This is how it works. If you have a major high or a major low created, normally what? They'll come to drop some liquidity to it. And when they come back again, they are going to sweep it. When they sweep that, find your confirmation and take the trade to the upside. That was it for this place. I try to find those that are very clear so that you can be able to understand. We see that we identified this as a major low here, and then that low was being broken. We got the broke here. Now this high was the one that caused the break. This is what I've already been explaining in the other videos. This is the high that caused the break. That becomes your internal liquidity. Immediately that high was being taken out, market pushed to the downside. That's your internal liquidity. But the highest high that was created after this low was being taken out is this high here. If that high is taken out, you are interested to take a trade to the opposite direction. And normally you can see how they came, respect the high here as if they're going to go down. Then they deceive us to the upside before the move came. This is where most traders get trapped. When they came first, they do like they want to respect it because it's a protected high, and you can take this too. You can take a trade here because it's a protected high. And if it fails, this is what makes the difference between the profitable traders and the non-profitable traders. If you take trade here, actually, I wouldn't hesitate to take a trade here. If I take trade here and then I get hit, I'm going to wait again for confirmation. You see how the market came and dropped down like this? This was the shift in structure. For us to understand that now market has taken liquidity from here, you have to wait for market to pull back into entry zones, normally back into that same liquidity line, and then from there market now drops to the downside. These are the specific trades that will stop you out and then go your direction, and you think that, oh, what happened? And by then, if you do not understand this, you have fears in your heart to be able to take this trade now again. But if you understand the high we are taking out, and then you understand that this is a shift, and then there is a confirmation for you to take the trade, you can take it all the way down again. That was external liquidity being grabbed, and then we came down. But look at here. This high which we created was a major high. We came here, created this low. After this low was created, if it breaks this high, it becomes a major low. Now they took that low out, and market from that point, normally they would buy from a support. We will still get to that, and then we add that into the strategy, and everything will start to make sense. So they tap on the support, take the liquidity from this low now, and the trade comes from here. From this point, market traded all the way to the upside. So all this was external liquidity. And you can see here, I put this one here. This is an example of relative equal lows. We will tackle that in other videos. We can see here, market created this low. After it broke here, it created this low, which took this low out and this low out, making this a valid major high. If that high is taken out, we would like to find confirmations to get in. You can always see after that high is taken out, they break structure and then they pull back to the entry there, and you can take it from the way down. This was messy structure, but if you hold it still, it will come to hit your TP here. And then we came back here. So now you have to connect the dots to be able to understand what I'm trying to teach here. This is a major low. If we put a line here, just look at the cursor. If we put a line here, we can see that this high is the one that caused the break. It's the one that caused the break. You can see from here, we broke, we gave this pullback and then came down. This becomes your internal liquidity. So after the break, they come, take the internal liquidity and drop. But before that internal liquidity, this low has been created. It took out this high, created this high here, and then market came all the way down. That means that this high here was a major high. Market came, traded back into that high. Immediately that high was taken out. You find confirmations within this zone, and then you take the trade to the downside. They come back and then drop liquidity again. This is how the market works. It's not for you to just be identifying random highs and lows. Understand what the highs and lows have done, and if they are being taken, what will happen. And you can see here, it was the same. They took out this high, took out this high here, hence becomes a protected high. They will come to that high. You see, many people are going to get trapped into this move. They'll push, go to your way small, and then they stop you out just by some pips. and then they'll come to your direction. You will think that, okay, maybe your trade has failed and you will not enter again, but that's the time to now enter the trade to your direction. If you understand this was a major high that has been taken, hence that's the external liquidity. Drop a like if you like the video, share, and then subscribe. I hope now you understand how the external liquidity works. I know just one video sometimes is very, very difficult to be able to explain everything. Drop a comment in the comment section and ask questions. If there is anything you need for me to explain or answer, I will be glad to do that. Subscribe to the channel and let's meet in the next video.